Thanks for clicking! 60% of Canadians renewing their mortgage in 25 and 26 could see their payments go up. This according to a new report coming from the Bank of Canada.
Nuh-uh.
Yeah, in the recently published report comes at an opportune time. As we talked about on this channel, there was a TD report recently released, widely covered by the media, indicating that the renewal wave was cresting and that those renewing could save $1,500 per month. I critiqued that report on this channel for glossing over what we're actually talking about when we talk about the mortgage renewal wave, those that had 5-year fixed rates in 2020, 2021, and early 2022, or those with variable with fixed payments and 90-year mortgages. And now, as further proof that the governor is an avid fan of this channel, he's had his minions whip us up a report to fill in the gaps. So what I want to do today is go over the Bank of Canada's report, take a look at how it compares with A, the TD report released last week, and B, the study that we did on this channel nearly 1 year ago, and then discuss some implications.
Smarten up.
The Bank of Canada is set to make its interest rate announcement in a few weeks' time and have a press conference thereafter, and we'll obviously cover both on this channel. Make sure you click, like, and subscribe if you want to get those updates, but for now, let's get into the bank's report. On to the report from the Bank of Canada. The bank starts with the assumption that interest rates will play out over the next year, largely in line with market expectations. And those expectations say that fixed mortgage rates will be largely where they are right now, with bond yields hovering around 3%, or exactly where they've been for the majority of 2025.
Nuh-uh.
Armed with that knowledge, the bank found that 60% of mortgage holders renewing in 25 and 26 will see increases in their mortgage payments, with the majority of those being those who hold fixed-rate mortgages. Difference from the TD report that said only 40% would be renewing at a higher payment, and unlike TD, the Bank of Canada actually tells us where that payment's going to land, about 20% in 2026. Now, that 40% claim from TD does at least try to reference a study from the Bank of Canada, though TD doesn't cite it, and looking at further research on the Financial Stability Report released last month, the bank said it was going to be 60% of mortgages that were going to see increases. So TD, a bank with access to much more data than you or I, doesn't even try to do its own study, and the study that it references is either an old one or, judging from its citations, doesn't even exist.
You have to hire the best expert.
Regardless, the Bank of Canada's prediction of an increase in mortgage payments of about 20% largely falls in line with a study that we conducted on this channel nearly a year ago, where we found that the mortgage renewal wave was going to peak, the payment increases were going to peak at about 20% in early 2026. Payments don't really start to go up until May of 2025, and then hit their peak increase at about 20% in February of 2026. And all I had was a mortgage calculator and Stats Canada.
The f*** is that?
Meanwhile, as we covered on this channel, TD didn't bother to run the numbers on what these payment increases could look like, merely noting that if you took out a $1 million mortgage a year ago, your payment was likely to decrease by about $1,500, and then, of course, without question, the media ran with it. Next, the central bank took a look at the other worry, those with variable rate mortgages with fixed payments, those negatively amortizing mortgages that saw their amortization rise to 60, 70, 90 years just a few years back, and it found that 10% of those borrowers could see their payments rise by as much as 40%, whereas on the lower end, they could see their payments drop by around 7%. Remember, on those negatively amortizing mortgages, they had a variable rate with fixed payments, so even when variable rates went through the roof, their payments stayed the same, meaning they weren't paying off any principal. Especially if they didn't make any extra payments, they are set to see great big increases. The bank does note that these payment increases will obviously be dictated by what those individuals did throughout that term while they were making that same payment. If they increase their payments, they're probably in better shape. However, if they were maxed out, if they took a variable rate mortgage just to qualify, just to maximize their borrowing power, as Canada's leaders in our real estate industry suggested that young people consider, then they'd be the ones on the upper end of those payment increases. So, all in all, the Bank of Canada is giving us a lot more information than we got from TDBank. With that said, at the end of the day, the Bank of Canada is still a bank. While the TD report made the argument that the renewal wave might not be so bad as incomes have increased and there's still a lot of equity in people's houses, so they can always borrow more money if they have a problem making the payments on the money they've already borrowed, the Bank of Canada was also quick to note that incomes have risen and that people can take money out of their homes to help manage.
We'll dig our way out.
But the main point is, while the real estate industry has made a concerted effort to downplay the effects of all of those 2020, 2021, and early 2022 mortgages coming up for renewal, using data available from OSFI, Canada's banking regulator, tells a much different story. Regular viewers of this channel will remember back in winter of 2024, Royal LePage CEO Phil Soper told Bloomberg that the mortgage renewal wave was really nothing to worry about, that it was, in effect, almost over.
Much less than some would lead you to believe. We're over halfway, considerably over halfway. We'll be 3/4 of mortgages written during those pandemic lows will have rolled into post-pandemic rates by the end of 24.
And if you'll remember, the interviewer said absolutely nothing. Moved on to the next question after Soper made that ridiculous claim. Fast forward to now, front page news.
Hey, guess what I found out?
Now, I trust the government just about as much as I trust a bank. I'm not really sure who's worse. But unlike the reports that we get from the real estate industry or that we get from the banks, the one that we got from the central bank gave us their dataset and their methodology, which means we can replicate their findings if we want to. This is what a quasi-scientific report that has predictive value should look like. First, a very brief summary of how I collected the data, as the ability of others to replicate your data is one of the main cornerstones of basic research. The Bank of Canada tells us where exactly they're getting their projected mortgage rates, the market, whereas TD just tells us that they're forecasting another 40 basis points in rate declines in 2025. And the study that I did in summer of 2024 did very much the same thing as the Bank of Canada is doing now. Here's the data, here's what I'm going to do with it, here are the results. And using a very similar methodology, I used the data from Stats Canada and assumed a 3 or a 4% interest rate come 25 or 26. We got very much the same results as that of the central bank. If we use, say, a future fixed rate of 4%, this is the increase in payments in 2025 and 2026. Now, I don't bring up last year's study as a means of saying that I was right, as I wasn't. The data did the heavy lifting. But what I am saying to the banks, to the media, to the real estate industry, that if you undertake a genuine attempt to get at the data, use transparent data methods, and outline your methodology, you'll have much greater capacity for prediction when you present your studies.
If you would just use your brain once in a while, you might like it.
Further, you also get to set a good example for the powers that be. I had criticized the Bank of Canada governor last year during that same video for not being transparent about its market rates. If Canada doesn't give us a link to the market expectations data that it's using, meaning we can't replicate and assess its findings. The governor got his PhD in economics from Western University. He should know this. Be better.
What did you say?
Fast forward to this year, and that market data is now listed in the report. You know, between us sending the children's book on the link between inflation and money printing to the governor in December, and then the BoC releasing a report in January, all but admitting that link, to now them releasing a study filling in the gaps on the TD report and being even more transparent about their data, I think the governor does in fact watch this channel. With that said, there are obviously a lot of unknowns right now. The future is massively, massively unpredictable. The Bank of Canada's projections do not consider rises or falls in unemployment. They do not consider the impact of tariffs, both of which will be pivotal in A, how high mortgage payments are in 26, and B, Canadians' ability to manage them. With that said, we will obviously continue to track the data on the renewal wave on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.